Good morning. My name is Vladimir Tikhomirov. I'm chief economist at BCS Global Markets, and I'll give you my macro outlook for the coming week. The past week has been not much different from the previous couple of weeks. We have seen a combination of factors on the economic side that point to stabilization in Russian economy and continued high risks on the political side related to possible new sanctions that could be introduced by US and Europe against Russia. On the economy side, the statistics that were published by official statistical office in Russia have shown that there were quite clear signs of stabilization and actually even growth in certain segments of Russian economy at the end of last year. Particularly in the manufacturing segment of industry, manufacturing has posted more than 4% year-on-year growth in December, which was very, very strong. And PMI, manufacturing PMI numbers that came out today actually point to continued growth. They're above 50, which points to expansion in this segment of the economy, which is positive. However, the macro statistics also shown that overall picture in the economy remains mixed, particularly in the consumer segment, which remains under pressure. Retail sales and services are down quite significantly in year-on-year terms, which is not surprising given the quarantine restrictions that are still in place and a very cautious behavior of consumers because of the pandemic risks. We expect that overall macro dynamic would move into positive territory from second quarter onwards, driven by the base factor effect, as well as continued stabilization in output. One indicator which is quite disturbing on the macro side is actual inflation. Weekly inflation numbers show that inflation pressure in Russian economy continued to grow during January. According to these weekly numbers, inflation currently runs somewhere at 5.3, 5.4% year-on-year, which is well above 4.9 we have seen in December, and significantly higher than the official central bank rate, which is 4.25. This rise in inflation actually increases risks that the Central Bank of Russia could actually start to tighten its monetary policy. We still believe that that's not an issue on immediate agenda of the central bank. We don't expect any change in the rate in February. We believe the central bank would decide to retain the pause in rate moves and would wait for change in the inflation rate, particularly from second quarter onwards, driven also by the base factor effect. However, if inflationary pressure continues to grow, risks are that perhaps in the next 1 to 2 months, the central bank could actually decide to push its key rate up. And another last big indicator on the macro side is the FX rate of the ruble. We have seen ruble actually remaining under pressure, mostly because of the geopolitical risks. These risks have been in place for quite a while, but over the past weekend, we actually believe that they could come up again. It was reported that Navalny team submitted some proposals for new sanctions against Russia to US and European leadership. And the list apparently includes some top politicians as well as some top businessmen. If such sanctions are going to be introduced, that could actually affect a number of large Russian traded companies because of their link to these persons on the Navalny list. So that actually could lead to more pressure on the ruble from the geopolitical risk side. We do not rule out that the ruble could again cross the 76 to the dollar mark this week, again falling below this mark. Overall, our view on the ruble moves this year remains intact. We actually expect gradual appreciation in the currency towards 73 or so rubles to the dollar by mid-year and 70 to 71 rubles to the dollar by the year end. But of course, much would depend on where geopolitics are, and it is very, very hard to forecast any future changes in this area. That's all on my side. Thank you.